Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. We are featuring a podcast recorded on March 14, 2018, as part of PwC's Tax Reform Readiness series. This podcast includes a discussion on foreign-derived intangible income, specifically what FDII is doing and the key considerations. The panelists include Mike DeFranzo, a PwC tax partner focusing on international tax issues, Shani Sean, a PwC tax partner also focusing on international tax issues, Paige Hill, a PwC tax partner and leader of our transfer pricing practice, and Michael Leckie, a PwC tax partner focusing on quantitative solutions. Take a listen.
Okay, I would like to welcome everyone to a discussion of foreign-derived intangible income. I have with me Paige Hill, leader of our transfer pricing group in the U.S. firm. I have Michael Leckie, who is part of our quantitative solutions group, weekends in Cleveland and lives on airplanes, and Shani Sean out of our Atlanta office and international tax partner. And I'm Mike DeFranzo with PwC here in Washington. So, Paige, maybe when we start talking about foreign-derived intangible income, we start with what is it trying to do?
Thanks, Mike. I mean, what this provision is really doing, you can go through the calculations and the formula, and there's a lot of materials out there on that. What it's really doing is looking at all sources of income from both services and product sales and royalties from foreign use, and that's defined. And it's capturing that income, and you're getting a beneficial effective rate on that of 13.125% when you look at how the deduction works. And so what it's really doing is looking at, trying to, analogous to GILTI, trying to reward companies for having domestic sourced and produced services and goods that are exported to foreign markets. And so it's really an incentive for companies who are doing that.
Okay, but what if, and I think that was clearly the intent, but, part of the mechanics of this is you start backing out what can be your foreign-derived intangible income, and there's certain things that are going to come out. Obviously, we have a more in-depth webcast that goes through all that, but if you're capital intensive to produce those widgets.
Right, and I said earlier, it's analogous to GILTI. And in GILTI, you'll recall that there's this QBI return, a 10% return on your qualified business assets, where in GILTI, that helps you to have a large capital-intensive base. In FDII, it's going to hurt you if you have a large capital-intensive base in the U.S. because it's going to reduce the amount of FDII that's potentially available for the beneficial rate.
So, Mike, it seems like modeling is going to be pretty important when people are sort of pushing through these numbers and figuring out how beneficial is FDII for.
Yeah, I mean, as Paige mentioned, right? I mean, there's kind of mirror system between GILTI and FDII. There's other provisions in this new law. There's also old provisions that have been around for 30, 50, 100 years that all interact with this. And so I think the modeling piece of this is going to be very important to not only get into the granularity of the computation, know what your FDII number is, but also, too, how all this is going to interact with each other, how one computation could affect the next computation, and that's whole snowball effect. And so I think that's where, I think this is going to become very important to look at it not in a silo, but as an overall picture.
I mean, that would include future investments, too. Aren't you going to have to put that into a model and decide? I mean, if you've got an opportunity to build a plant in the U.S. or a plant in, we'll make it easy, Canada, and you're looking at what does that mean under GILTI or what does that mean under FDII?
Yeah, I think this is just one more decision point, right? It's just one more thing that you have to consider now when you're making those decisions. It's not going to be the sole decision maker, but I think it's going to, influence it potentially and be something you'd want to make sure you have an understanding of before making that decision.
Shani, there's a lot of new terms in these few pages of statutory language, but how do we navigate and work through those? We've been told by the government we're going to get regs, but we all know regs take some time. So that means at best probably late summer, maybe spring. Maybe fall, could even be 2019, who knows. But in the meantime, we've got to get through these provisions. So how do we get through the provisions?
Yeah, and Mike, I think a lot of companies are going to continue to hear the same answer, which is that until we do get additional guidance, I think taxpayers have to look to analogous guidance, like Paige and Mike were saying. What existing authorities are out there to help taxpayers support their position.
And what are some of those places they're going to be looking?
Sure. So 954
right?
in the Subpart F rules is a great place to start. That dictates, rules determining the place of use for sales of products. You could also look to 863B as well as 956.
So I love to hear that, and I think in our webcast we've even talked about 97 and some other things too. And the reason I love to hear that is whenever you have reform as dramatic as the reform we just went through, I felt like everything I knew just went out the window. But I love hearing that I'm going to be able to look to some of that old knowledge and help me navigate through this new rules. So overall, we look at the policy here. I think there's some questions about. I mean, we just talked about the infrastructure investment incentives are maybe not aligned, but there is certainly a benefit to having domestic income that wasn't there before. And so we start talking about maybe how do clients react if you're going to have a greenfield opportunity and you're going to build a new business. Does it really change the decision point between opening that new business line in the U.S. or foreign, and you start to say, well, maybe I can do it here in the U.S.?
I think that, I think it's another factor. I don't think it's a slam dunk because I think there is concern about the longevity of the provisions. There's concern about the domestic rate creeping up in any event. And I will say even, my experience is some of our greenfields are our most sophisticated tax planners because they're also starting fresh. And so they don't have an existing operating footprint and they're very open-minded. So, and I think they're thinking very globally in terms of how they're expanding. So, it will be a data point and maybe it's a starting point, but I think there's also concern about the cost of getting intellectual property out of the U.S., prospectively under some of the additional laws that came in as well.
Right. That's the revised 367 regs that came through in the last year before the statutory change, and then the door's been closed that everything's taxable pretty much.
Everything is taxable. Yes. That's right.
Okay. Well, thank you very much for your comments on foreign-derived intangible income.
Thank you for listening to this podcast. If you would like further information about this topic, please email the participants whose email addresses can be found in the description of this episode.